Now that we have a fair understanding of the basics of corporate taxation, we shall now move on to the next session, where we'll be covering tax groups, permanent establishments, and other related topics. We have a speaker from UHY James, Mr. Amit Mehta, to give more insights on these topics. So a quick speaker introduction. Mr. Amit Mehta is an experienced tax advisor and has worked with leading corporates, having exposure to a wide variety of clients from diverse sectors. He is presently Associate Partner Taxation with UHY James. He is a qualified chartered accountant and has graduated in commerce from Delhi University. Amit has vast experience in corporate tax, VAT, ICV, and other financial engagements in various industries. He has over 13 years of varied professional experience across tax, finance, accounts domains under cost analysis, revenue audit, stock audit, bank audit, tax planning, assessment, accounting, budgeting, and projections. Amit has taken active role on firm's technical advisory front and has attended various seminars and trainings, including diploma in IFRS to gain hands-on experience in IFRS. Join me in welcoming Mr. Amit Mehta.
Hi, thank you. Hi, very good morning, everyone. First of all, I would like to thank ICAI Abu Dhabi Chapter for giving me an opportunity to speak on these three topics of proposed corporate tax regime. To start with permanent establishment, I'll just take a minute just to take you to understand the taxability, the basis of taxation for the legal entity. The legal entity, we can say that we can categorize into two parts. First is the resident company and other is of non-resident company. So in resident company, the definition says that any company which is incorporated or established within UAE shall be termed as resident and their global income will be taxed in UAE. On the other side, the non-resident, any foreign company who is having POEM in UAE shall also be considered resident. So non-resident definition is very selective, or I would say is very exclusive, which says foreign company who doesn't have POEM, place of effective management within UAE, shall be considered non-resident, and their taxability will depend upon the income attributing to the permanent establishment. So why I am taking it, why I am recalling the definition, or I would say basis of taxation for the legal entity, is that it's important to mention that the concept of PE basically need to be understand with respect to a non-resident taxation. So any income attributable to the PE of foreign company in UAE shall be considered, shall be determined through this concept. So basically permanent establishment PE concept is a international tax, is a principles of an international tax law which is followed across the globe. The main purpose of PE concept is to determine and establish the presence of a foreign company in a particular jurisdiction. Here we can say the foreign jurisdiction, which is UAE. So to determine and establish the presence of foreign company in UAE to justify the levy of taxation. And this determination is done, generally done on the basis of local tax laws and rated provision of double tax avoidance agreement entered into. In the situation when the DTA is not been signed, then this determination shall be done on the basis of local tax laws. In UAE, the determination of PE shall be done on the basis of guidelines specified under Article 5 of OECD Model Tax Convention, which provides two primary tests that need to be conducted to identify or to determine the PE for the non-resident in UAE, and those are first is the fixed place of business, second is the dependent agent. So fixed place, what is fixed place of business is? I would say any place from where the business activities or business is being carried out either wholly or partially. Article 5 of OECD model tax specifies what can be considered as a fixed place of business, which says either a place of management, branch, even though branch are considered only the extension of a company, but for tax purpose, for PE concept, branch are considered as a standalone establishment for which any income attributable or any activity that is conducted to generate revenue or add value to the ultimate core activity, that will be considered. Then I would say the temporary office or other house, I would say the home office of an employee, any factory, any warehouse, or any activity which is performed with respect to the establishment, with respect to the, I would say, building site for more than 6 months, that will also be considered as fixed place of business, and fixed place of business itself considered as a PE for the non-resident, or I would say foreign company who doesn't have POM within UAE. But there are some exceptions also being provided, which says just having a PE or just having a fixed place of business does not qualify to consider as a PE, and that exceptions are taken care with respect to the activities that is being performed, that is being carried out from that fixed place of business. Activity says, there is an open term, very, I would say, subjective, which says any activity which is auxiliary or in preparatory in nature. If that activities are being performed from the fixed place of business that is identified above, then it will eliminate it from being considered as a P. I'll take you example. If I have there is a branch of a non-resident company in UAE that are just performing, let's say I would say the activity covering gathering of information or market research, then considering the exceptions, that branch will not be considered as PE and their income will not be subject to tax in UAE, being it's not a PE of non-resident. Likewise, one more exception is provided. It says if the fixed place of business is being used for storing and dispatching or delivering the goods, or storing and delivering for the further processing, that will also not be considered. Means here the fixed place of business would be warehouse. Here if in UAE the warehouse is there where the goods of a foreign company is stored and delivered to the respective buyer. In that case, it should not form up B. But exception is always there, because after understanding these exceptions, so many businesses started breaking down its process into different activities so that to qualify it as a qualify the definition of auxiliary and preparatory nature, which is itself is not clear. It's a wider term which says any activity which is performed as a auxiliary and preparatory of nature with respect to a core activity will not be considered as PE. So I'll just take you one example here. I would request if anyone can answer. In this example, these are e-commerce industries there where the company has one warehouse in UAE, and can it be qualified as P, where the objective is what the activity they are doing, just storing and delivering the goods to the goods of non-resident company to the customer in UAE. Can it be classified as fixed place of, or can it be can one claim the exception rules on that? Answer is no. Reason being, even though it is apparently is mentioning that if the warehouse is there and goods are stored and then delivered, but come to the important point, it says that it should be in the nature of preparatory and auxiliary nature activity to the main core business. I am talking about the e-commerce industry where the main core business is to deliver the goods at a doorstep of the customer, and where storing and delivering is an important part of the distribution segment of that industry. So if we go by the definition auxiliary and preparatory in nature to the core activity, in that case it fails to do so. So it's a questionable activity. One need to understand what activity they are doing and what activity they are calling for to get the exemption with relation to the core activity of the I would say parent company, or I would say foreign company, non-resident company. Second test is a I would say the dependent agent. So it says even though the company foreign non-resident doesn't have fixed place of business, but still, and they are doing business through an agent in UAE, can it be qualified? Yes, the rules provides the condition under which an agent can be termed, can be called as a dependent agent, and accordingly will be classified as a P of non-resident. It says the agent with whom the non-resident company or foreign company is doing business that agent must have power, and that agent regularly exercise that power. It says the word used habitually exercise its power to conclude the contract without material intervention of a foreign company, and that contract, the outcome, conclusion should be binding on the foreign company. So if I am an agent, I am an exclusive agent, I am doing some contract, and I have been given the right, I exercise that right to conclude the contract, and what I am concluding, that is binding upon the foreign company. In that case, I will be termed as a dependent agent for my foreign company, and I shall be considered as a P for the foreign company in UAE. There are some exceptions, yes, while if we do the planning, we need to understand here what things can avoid us from being a dependent agent. It says that two conditions are there. Firstly, the agent must be independent. It should be legally independent and economically independent. Means structure wise, shareholding wise, management wise, I should be independent. Along with that, the transaction that is happening, the contract term that is there, I should economically also, I should be independent from the foreign country. Second condition, that whatever the activity I am doing, that I should in a normal course, in a regular course of business. It should not be specified to the particular transaction or a particular contract. Let's see one example. There is a one exclusive marketing contract has been signed between the company in UAE and a company A, maybe outside UAE, anywhere around the globe. The terms is that the company in UAE shall manage the business, I would say digital marketing business or marketing business in UAE. They have given the region. And the fees will be the percentage of the whatever the sale will be concluded in UAE. And decision making with respect to buying the space for advertisement, for hiring the employee, or any decision with respect to the business within UAE is in the hands of the company A, so in the company within UAE. And whatever the contract been concluded shall be the responsibility, shall be signed by the company in UAE without material intervention, so that they are acting as a principal, not as a middle person. In that case, how we are going to treat this? It will be a dependent agent, because all the condition has been satisfied. Where it's saying is a firstly exclusive contract is there, means economical dependency is there. Secondly, whatever the sales I am getting in UAE, all would be concluded by me without material intervention of my foreign company, and that is also binding upon them. My revenue is also linked with their sales within UAE region also. So this example will take us to the qualified for the dependent agent, and yes, in that case, my company, as being an independent person, still my company would be considered as a P for the foreign company in UAE. This condition would have been different if only the contract would have signed between foreign company and company in UAE with respect to providing the services like managing the, I would say, digital platform, providing, even though fees would be there with respect to the sales, but yes, my role would be only limited to managing the business, whether sales are happening or not. I won't be in a position to conclude the contract on behalf of any my foreign company, and foreign company would not be responsible for any deed that I do other than the managing the site or marketing operations. So these are the two main, I would say. Can I ask a question? Yeah.
So in this case, the entire 100% sale will be taxable?
Yes, we have to now to check what income is attributable to that P. Income attributable to that P need to be understand accordingly. Attribution basically is calculated like in calculation is done as if I am doing the business in a independently. All expenses, all revenue will be considered, and accordingly it will be taxed in UAE. So this was the two major tests that need to be conducted. Any non-resident company who's to understand, firstly determine whether they have a PE in UAE or not. If they have a PE, then through this test, if they have, then income attributable to the PE shall be subject to tax in UAE. My next topic is tax grouping. Is an important one. Why? Because as we all know that in UAE, the large businesses are being operated through the group of companies, and to address the ease of compliance, the concept of tax grouping is proposed to be introduced, subject to the condition which says, basically 3 conditions are there. First condition says that the tax group must be a resident group in UAE. Means that all the entities within UAE must be resident, and resident definition I will repeat again. It says any company which is incorporated or established within UAE will be considered UAE resident, plus any foreign company that has a POEM in UAE, that also be considered resident. So all the companies must be resident in UAE. Secondly, the parent company must hold at least 95% of the shareholding or voting right in its subsidiary. If I am a parent company, I must hold a 95% of shareholding or voting right in my subsidiary to form it as a part of our tax group. Second condition says about the member, the status of the member. It says the exempt person and free zone person that enjoying the 0% benefit, 0% tax rate benefit, shall not form a tax group, shall not be a part of a tax group. So they have exclusive definition with respect to this condition. Third is says financial year, which says all the members in the tax group must have a same financial year. Means if my parent company is having the financial year starting from Jan to December, then the entities or subsidiary who we want to be a part of a tax group must have a same financial year from Jan to December. Any entity having a financial year, let's say from April to March, that will be excluded. That cannot be a part of the tax group. And yes, process flow would be there, where the notice must be signed by parent company and subsidiary, and must be shared, must be sent out to the FTA to inform them, yes, we are forming this tax group as a process. Now let us understand who from this structure, given structure, who all can form a tax group. First of all, my assumption, I have taken the assumption is that firstly all the entities mentioned in the structure are resident in UAE, my assumption, and they have a same financial year. Now 2 conditions I have already assumed. Now remaining 2 conditions are there with respect to the I would say the shareholding by the parent company, and second would be exclusion of member, which say the free zone exempt person should not be a part of this. So if we look at this structure, where the company A is a parent company, B and C are the subsidiary, even the company FZ is also a subsidiary of company A, and company X is there. In this structure, first, if the third condition, which say the exempt and free zone person should not form a part of a tax group, so straight away we will exclude this. Company FZ cannot form a part group, cannot be a part of a tax group. Let's move to other. Now condition, only one condition is left to understand about the participation of the, or I would say equity held by the parent company in other members, which says 95% of the equity, share capital or a voting right must be held by the parent company in its subsidiary. For my understanding, I have divided into 3 parts that will help you also to understand. Firstly, where the parent company directly holding 95% or more in its subsidiary. From this structure, we can say the company A directly holding in company B and company C more than 95%. So yes, they can form a tax group. Second condition says even the branches of a parent company and of a subsidiary can also be a part of a tax group, because again general rule says branches are the extension of the main company itself. So yes, I can form a tax group including the branches also here. Third condition says yes, parent company must have 95% of shareholding or a voting right, Directly I have covered. There is a condition for holding indirectly also. Means if the parent company holding 95% of shareholding indirectly along with its subsidiary, then it will also be part of the tax group. You can see the parent company is holding in X, company X is 50%. However, other way around, the company C is also holding 50% in company X. So collectively, that's amount to 97.5%, which is more than 95%. So company A, B, C, company X, along with its branches can form a tax group. From this slide, let us understand, okay, one is there like what we can form, but what the benefit we can get out of, we can get from forming a tax group. In this structure, if you can see that directly investment, directly shareholding, company A and B and C can form it, its branches can also form it. What about company X, where it is having a loss of 2 million? They cannot form. Reason being, direct investment only 50%, and there is no provision or no condition for indirect investment along with its subsidiary. So even though free zone company, in any case we cannot form, since they are enjoying already 0% tax rate. So these company A, B, C along with its branches can form a tax group. But yes, if they will going to from the condition prospect, they will form a tax group. But whether it is beneficial for them to form a tax group or not, let's understand. Just check the calculation part. Here, as a tax group formation, when they form a tax group, their liability, tax liability is coming out 371,000. However, if they would have calculated their tax liability individually, it would have been lesser by at least 67,000. So why this is so? Even though tax group is there, I should get lesser liability, but why this is happening? The reason is very simple. If all the taxable profit making companies are there in a tax group, definitely the cumulative effect will be there, but they won't be able to enjoy the threshold limit, because individually they would have enjoyed individually 375,000 as a threshold limit. In a tax group, they will going to enjoy at once only. So what are differences coming is because of the threshold limit only. Now I'll take you the second example. In same company A directly has a share capital in company B, company C along with branches. Now indirectly parent company is holding the share capital more than 95%. Indirectly 50% plus 50% by company C as being a subsidiary, and collectively it comes to 97%. So yes, free zone company anyways we are not considering. So this can form a tax group. Yes, we can create it, but what's the benefit I am getting out of it? You can see the calculation. It says that involving a loss making entity, tax losses with a tax group are allowed to be set off, to be adjusted in a same year without any condition. If we check the group set of provision, it says 75% of the income can be only be adjusted and rest should be carried forward. So no such condition is there. If any entity is there in a tax group and loss making is there, then its loss 100% can be set off from the income available within the same period, within the same year. So consequently, even though they are enjoying the threshold limit only once, but cumulative impact is that there is a tax saving of 112,000 with this structure, because adjustment of tax is there. Sorry? 90%, 5% is there, na? Cumulative impact is there. Parent company along with subsidiaries is holding more than 95%. No, that was not there. That was only parent company was having 50%. Yeah, this is something that one need to understand. Their near future business, they need to stimulate accordingly. First benefit need to be understand, then person can go to the condition and make the adjustments accordingly. No, I am not saying this. From the simulation, yes, there is a condition. There are different conditions are there. If no, in the in the large organizations where the multiple companies are there, if any company initially definitely considering the situation, market situation, and I would say startup would incur the losses in maybe in 4 to 5 years. So definitely one can plan accordingly and can form a tax group. It's not, I would say, blind rule that don't go with the tax grouping if you don't have the loss making entity. Is that what person need to understand, need to analyze that situation, and accordingly one should go with this. In this, just understand, the company X was not been included, reason being the parent company is holding only 50% of the shareholding. The condition says 95% should be there, either directly or indirectly. Yeah, in this case, there is no shareholding. So with this example, yes, having a I'm coming on. Right. So with this example, yes, having a loss-making entity as a part of a tax group, they will give an add-on benefit. Yes, first benefit, I'm again just to clear the ambiguity, I'm not specifying that you should have a loss-making entity in the tax group. The first and foremost objective of having a tax group is the ease of compliance, and definitely one can get the benefit of associate cost saving also. I'm just simulating what could be the condition and how additional benefit can be taken out of it. In my last example on this tax grouping, till company X, everything is same. Here's a free zone company with a loss of 1.5 million. From the conditions, if free zone company is enjoying the benefit of 0 to 8%, they cannot form a tax group. They cannot be a part of a tax group. But there is a provision also for the free zone company, they may opt to be taxed at a regular rate and enjoy the other benefits available to the other regular companies, I would say normal companies. So if I take in my example, I consider that this company FZ opt to be a part of regular company and should be taxed at 9% instead of 0% tax rate. So I would say the complete structure would be considered to form a tax group here. Benefit, yes, if my free zone company is there with a loss making, I can, and that can be set off from the available taxable income. So in a first year itself, in the current year itself, I can get the benefit without any condition, without any carry forward, without any mark of having percentage of set off. So you can see the difference. Having a loss making entity or having a free zone company and opting to be taxed at 9% will give a benefit subject to the conditions or the near future plans what the company is having. So this was all about the tax grouping. What can be a part of a tax group, and while evaluating what need to be checked to form a tax group. Last topic for my today's session is business loss, and how it can be carried forward, and about the set off. So first question comes at whether all the losses incurred by the company can be carried forward. So answer is no, because in PCD itself is mentioned there are 4 categories where any loss which is incurred before the implementation of the regime, the tax regime, will not be allowed. Any loss, a tax loss is incurred before becoming a taxpayer, that will not be considered. Any tax loss incurred with respect to the exempt income will not be considered. And lastly, any tax loss incurred by the free zone company with respect to its free zone business will also not be considered. Reason being, they are already enjoying 0% tax rate. So what's the use of allowing them to carry forward their losses? Second question, up to what would be the I would say timeline that business loss can be carried forward? In PCD is clearly mentioned, it can be carried forward up to infinite years, n number of years, subject to the condition which says that at least 50% of the shareholding must be common for the year in which that loss incurred, and in the year when they want to set off to carry forward till the year they want to carry. If the shareholding up to 50% is not the same, then even it is allowed, provided that the same business or similar business must be carried on by the new shareholders. However, this condition is not applicable to the businesses which is listed on the recognized stock exchange. Another question comes, okay, carry forward is fine, but after carry forward, how this set off would be done? So set off of the losses can be done in a subsequent year, subject to 75% of the taxable income available. I'll give you example. Let's say my first year of taxation would be year 2024. In 2024, I have incurred the loss of 2 million, and my conditions are there because I am fulfilling the condition. In 2025, I have earned the taxable profit of 1 million. So as per the regulation, it says 75% of the 1 million, that is 750,000, shall be allowed to be set off from the loss of 2 million, and balance 1.25 million will be carried forward to the year 2026. And accordingly, if let's say in 2026 also I am getting the taxable profit of 1 million, then again 750,000 shall be allowed to be adjusted from 1.25 million, and remaining 500,000 will be carried forward to next year. So this is the whole concept so far. Yes. Sorry, I am not able to hear. No, there is nothing. No advance. Withholding tax provisions are there that Ms. Shruti will going to cover, but yes, so far it would be at 0 rated, and there would be no compliance and no return need to be filed. What the information is available so far.
Take the questions at the end.
Yeah.
We have a panel discussion and Q&A session at the end.
So, so considering to respecting the timeline provided to me, thank you so much. Here I conclude my session. Thank you.
Thank you, Amit. So now it's time to honor our speaker. So to do the honors and hand over the memento to our speaker, may I invite our General Secretary, C.A. Rohit, and his friend, Sapan Agarwal, on stage.